Yo, what's up, everybody? Mark Jenkins, A Trusted Realtor. We're tuning in to another edition of What in the World is the Fed Going to Do? No, I'm just joking. But seriously, we're going to take a look at the Federal Reserve meeting together and give you all some commentary. I am a licensed realtor here in the state of Georgia. If you have never heard of me or never tuned into this channel before, we are live every single day from 8:45 until around 11 with our Ask a Realtor series. There you can ask anything that you have or that you would like to know about real estate. You can ask about mortgage rates. You can ask about how to buy a home, how to sell a home. I mean, even this morning we talked about whether subject to is a scam. So we got a lot of tools on our channel. So be sure to like and of course subscribe to our channel. Got a lot of information here today. First of all, we're gonna wait on Jerome Powell to go come holler at us in about 5 minutes or so and let us know exactly what the plan is with these interest rates, with the federal funds rate. Those of you who don't understand what the federal funds rate, that's just the rate that banks charge each other to lend money amongst them. So right now we're at like in the 5.3 range. At least that's what my trading view says. And a lot of people are expecting them to raise rates again. Some of them are expecting them to pause. I'm going to give you some outlook on what is the outcome of each. I think you'll really like the information that we're going to share today. So if you are watching, please be sure to like, share, subscribe to the channel, because outside of just, covering the Federal Reserve meetings, we'll also cover a ton of information about real estate, stuff that's very important when it comes to you being able to decide what you're going to do, whether you're making a home purchase or you're selling a home or you're doing both. I mean, you really want to make sure that you do it in an informed manner, because the days of just hiring somebody that's, I don't know, just like your friend or something like that, you really can't do that when it comes to real estate anymore. It's just the market, there's so much uncertainty. And like I said, if you just hire anybody who's just a friend, I mean, obviously it depends on who your friend is, but if you just hire somebody based solely on the fact that they're your friend, it may not end up quite well from you here. So we're streaming live today. We're going to be live through, I guess, most of the Federal Reserve meeting. I don't know if I'm going to stay live for the entire Federal Reserve meeting, but after we hear the decision on whether the Jerome Powell is going to raise, decrease, or pause rate hikes, I'm going to talk a little bit about the implication that it has for the overall markets in general. Over the last, ever since they've been raising rates, we've seen pretty much everything slow down that's tied to debt. Housing prices have continued to go up since they started raising rates, which is a surprise to many. But to me, it's not really a surprise, especially considering that we don't have a lot of inventory. I talked about that in a recent video in terms of how inventory is slightly on the uptick. So like I said, please be sure, subscribe to this channel, comment below, let me know what you think. The store is coming. The new real estate course is coming as well. So just make sure you tune in to everything that's going on. I thought we're about to get started here in a couple of seconds here. I'm going to start this thing at 2:30. Hey, man, still got enough time to get your snacks, get your popcorn, so you can see what's going on, man. Listen, if they raise rates again, I'm not as, I don't want to say afraid. I'm not afraid of anything, but I'm not as worried. That's probably not the best word either. But if they do raise rates again, it's not as big of a deal to me, in my opinion, as if they pause. If they pause raising rates, which I believe that they paused the last meeting, I don't have it in front of me, but we're gonna go ahead and jump into it, man. We're live. Let's get it. It's real quiet in that room. Like, Nobody's saying anything. They're like, oh, what's going to happen here? So we're waiting on Jerome Powell to come on out to the podium and go ahead and give us the game, man. So he's got that Apple computer up there, man. Way to shop American, semi-American. I guess it's American. Yeah, but everybody in the room is looking like they're getting their questions together and they want to figure out what's going on here. Here he comes, man. The man of the hour, Jerome Powell.
Good afternoon, everyone. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
Okay.
We understand the hardship that high inflation. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. Without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Okay.
Since early last year, the FOMC has significantly tightened the stance of monetary policy.
Significantly, I'm talking about it's tight out here.
Policy interest rate by 5.25 percentage points, and have continued to reduce our securities holdings.
I wonder what's on that iPad. What y'all thinking on that iPad?
We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
Ugh.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments.
What you got, man? What's the economic developments, man?
Indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago.
Yes, it does.
Higher mortgage rates.
Yeah.
Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP,
look at that chart, man.
Participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year.
Right.
The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years.
That's like everybody.
Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%, 4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations
I don't see no black people in there.
appear to remain well anchored, as reflected in a broad range of surveys
we in
of
there,
households, businesses,
I had a feeling, man. We up in there somewhere.
as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity.
Boy, wait till you see these charts, man. The chart's gonna explain everything.
The economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings.
What the stock
We are
market
committed
doing?
to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals.
Right. Everybody got to have a job.
Make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data
what kind of music
and
bro
the
we
evolving
listening to.
outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy
listen to rock
rate,
music.
but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
Ooh, wait, drop a bomb.
Additional policy
No, I ain't gonna drop it yet. I ain't gonna drop it yet.
To return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. It is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, cool, man. We ain't gonna go through none of these questions because, man, I cannot believe that they just decided to pause rates. I mean, I can believe it, but at the same time, I don't believe it because here's the thing. I gotta tell you, like, and I'm gonna show you on the chart. Nobody's gonna ask a question that I'm gonna ask or bring up the stuff that I'm gonna ask right now. So every time that the Federal Reserve pauses rates, something bad happens. For y'all who don't understand, the only reason that they start pausing rates, something's breaking, and the only way that they fix it is something bad, like really, really, really bad happens. And if you don't believe me, let's go to the chart. Boom. All right, so let's see here. All right, so we're just gonna start off at today, where we are now. It's over here, okay? Right now we're over here, okay? Now here, I blow this up for y'all large, man. I hope y'all not watching this on y'all phone, but if you're watching on your phone, get close to it, man. I'm about to teach y'all something. Every time they start pausing, something creeps out shortly after. That's really bad. All right, here we go. Last time they started raising rates significantly in October 15. All right, October 2015, those rates were all the way down to zero, and then poof, everything, like all the asset prices from like 2011 up till now, they just exploded. Housing, cars, the stock market, you name it, because they were eating and benefiting off of this low rate or no rate or zero rate period right here, the zero interest rate policy from 2011. That's how we were actually able to get out of the previous GFC, the Great Financial Crisis. I think that's what they call it. Yeah, the Great Financial Crisis, right? That's how we were able to get out of it, right? Printed the money, low interest rates, call it whatever you want, right? So then we go up, 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 up. And now in 2019, I was selling real estate. Then I was, coming up on 2 years, 2 years and some change of selling real estate here in Metro Atlanta. And I noticed that home prices and the mortgage rate and everything just kind of started to get a little wonky right around the summer. And I remember this like it was yesterday. In 2019, they were saying that they were going to raise the rates a couple of times in 2020. And then by the end of 2020, they were dropping rates. So it's like they were telling us they was going to raise rates, and then it looks like they paused. So they paused, right? Just like they're doing now. They paused. And then what came after they paused? Summer of 2019, they started to drop rates. Boom, 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 boom. And now they drop rates until pretty much the end of 2019. And then bam, out of nowhere comes COVID, drop it to zero. Boop, zero all the way down for like almost 2 years, right? So that's your first bad thing that happened when they had to drop rates or when they pause. So to me, when they start pausing rates, that just says get ready. When they pause rates, get ready, because there's one example. All right, let's go back. Let's go back a little longer. Okay. Now, here we go. 2002, right? Rates are still pretty low, 1.5%, 1%. Okay, so they start raising rates. They were too low. Okay, we're going to raise rates again. And then they raised from 2004 up to 2006. So those of you who don't know, that is when housing prices exploded again, right? All of this money, just like he said, it takes time for the interest rate decisions to be able to hit the market. And so it took time from 2003 all the way to 2006. And then when they got to 2006, what did they do? They started pausing. July 2006, they started pausing. Pause. And then July 2007, they started dropping it a little bit. And then bam. Oh, wait. Great financial crisis happens. After they pause, something bad happens. All right. And here you go. They left it at zero for a long time after that. But hey, everything fell apart right after they paused. Not while they was raising. After they paused, everything bad happened. All right. Okay. Maybe you're not sold yet. All right, cool. Let's go back to 2001. All right. 1998, rates were at its, I guess, low point for a little while. They start raising them. Okay, we're going to raise rates, yada, yada, yada. And then boom, dot-com bubble. right? .com crash, whatever you want to call it, right? 2000, they pause rates, and then what do you know? .com crash. Boom, all the way down. And so my point is that, like I said before he even came to the stage, I'm more so concerned about whether they were going to raise rates or pause. Because they paused, you want to get ready. That just lets you know that there are very, very systemic wide issues that's going on right now. And, you know, you definitely want to get ready. Something bad is going to happen. I don't know whether it's going to be something economic, like in 2001, something catastrophic, like in 2008, or something that will reshape your entire life, like what happened in 2020. This is serious, folks. This is very serious. And not to get too technical here, but you see this little gray area? That's called resistance, okay? Now, we're right here in this resistance zone. And it's not a shock that they pause. Now, if they're able to break over this zone, which is what? 5.75 range, which will be just one more rate hike, or maybe two, would take them right to 5.75%, which would be breaking resistance. If they break resistance and that becomes support, then rates could go up to, 7.5 in no time. But they pause. And that is just a really concerning thing here. They're not telling you what they really know. What they really know is that because of where the rates are, people aren't buying houses like they used to. People aren't buying cars like they used to. People aren't able to service their credit cards like they used to. People are going delinquent on their mortgage like they haven't done in a while. Mortgage demand in itself is at a multi-decade low. Evident by the applications, evident by the home sales. Like, there are major systemic problems versus getting up there and saying that, because you can't get up there and say that because you all would go crazy if he did. Versus saying that, he's talking in coded language. All right. Coded language is essentially other people know what they're saying and maybe you don't. And in this scenario, if you don't understand what a rate pause means, it means that something bad is about to happen. So how long do we have until something bad happens, right? After this pause here. All right. Obviously, nobody has a crystal ball. Hopefully nothing bad happens at all. I just hope I'm wrong. I don't mind being wrong. I will gladly stand corrected, right? But from the last time that they paused and had, let's say, 6 months worth of no increases, right? So they paused pretty much January 2019. So it took from January 2019, I'm going to count until it did a major drop. January 19 to April 2020. So that's like 14, 15 months. Okay. 14, 15 months. In that instance, we got July 2006 to December 2008 when it hit zero. So you're talking 2.5 years. And I get it. Like, it's not an overnight thing, but here's the issue. Or we could take it from when they started dropping. I mean, it's not really July 07 to December 08. That's what? 15 months. All right. They started dropping in July 2019, and April 2020 is when they got to zero. So that's July 2019 to April. That's like 9 months. All right. So you can probably say within the next 8 to 18 months, that you were going to see the wheels fall off of a lot of stuff here. They started cutting in November of 2000, and they hit the first rock bottom in like January of 2002. But apparently that wasn't low enough, which is why they cut it even more. All right. But we were already in the .com burst at this point. So not to get too technical on you, but just know 8 to 18 months from now, expect to see something happen. What do you think is going to happen? Could it be war? Could it be another pandemic? Could it be civil unrest? Could it be issues with the supply chain? Could it be natural disasters, if you get what I'm saying? What do you think it could be? Because history shows that once they pause, something big and bad might happen. So make sure that you comment below. I really enjoyed spending time with you today. Make sure that you tune in to Ask a Realtor every morning, Monday through Friday, 8:45 a.m., to where we cover important topics that affect or can affect you and your family. I give you solutions on what to do. You don't have to take my advice. It's just somebody who's not going to sugarcoat things, and somebody who has no incentive to lie to you. So if you appreciate that, make sure that you hit the like button, subscribe. I'll see you in one of the Ask a Realtor series. Share this video. There may be somebody who needs to understand this commentary better than you can describe it. Or there may be somebody who just completely doesn't understand what's going on with these interest rates. So buckle up and get ready, because things are definitely about to change. You want to drop a bomb on it? It's A Trust